Uh, David Madden, market analyst at Equity Capital, is joining in, and we've also got Aditya Shah, Chief Investment Officer at JST Investments. Thank you so much, gentlemen, for taking the time. I'm going to start with the global picture first. I will come to you, David. The CPI print, certainly something that a lot of people cheered, not just in the United States, but I think across the globe, because that overhang of high inflation, red hot inflation, inflation which is in fact higher than what we're seeing here in India, has been a significant cloud on risk assets. Do you see some of those fears abating at this juncture?
I do indeed, and of course you're referring to the US CPI numbers which came out yesterday. The decline in the CPI number suggests that a bit of inflationary pressure has actually disappeared, which could lead to the Federal Reserve and the likes taking a less hawkish stance in regards to future interest rate decisions. But on that topic about of CPI, today in the United States, we had only an hour and a half ago, we had the latest PPI numbers, Producer Price Index, and they came in below expectations and declined. The headline PPI reading came in at 9.8%. Below expectations, economists were predicting 10.4, and there's a sizable drop on the 11.3% seen in the previous report. So it suggests to me that if prices, it seems to me as if prices are falling at the factory level, that's likely to trickle down to the consumer. And with that, it's kind of more good news in terms of the squeezed consumers, because let's face it, in the United States, inflation is running at a much higher rate than wages are. So with that, that should actually down the line take a better pressure off the consumer. And in turn, what we're seeing is with the PPI numbers today in the United States, we've seen the US 500 rally. The US 500, S&P 500 rather, has gone on to hit a new 3-month high. So overall, traders are a bit less cautious and a bit more optimistic about the future.
I will come back to you on the jobs picture because that's the other major thing to track. But Aditya, I'll come to you on this next one. Of course, it has been said that the Indian equity markets have been more resilient. We've faced consistent selling by FIIs over the last year and a half. And the question really is, will the earnings keep pace with these expectations of resilience? Or do you see that some issues will crop up? Inflation has left a dent.
First of all, Alex, good evening. I completely agree with Rhythm that India is in a long-term bull market. We have seen a little bit of correction in the market because as inflation rises across the globe, we are on a steep interest rate cycle. But as we think somewhere between August, September and October, the inflation cycle could really start to peak and we could see lower readings across the US as well as in India. So we think that the interest rate, it's a very steep interest rate hike cycle, after which next year already we will start to see rate cuts. So in my opinion, over the next 1 or 2 quarters, earnings will be a mix as companies start to settle down with the inflationary pressures. However, after that, the earnings will start to catch up. I believe that we are broadly trying to form a bottom to the market, and from here on, things could be much better. And as we say, as Rhythm already said, we are in a long-term bull market in India. FIIs have continued to sell in India, but domestic investors, led by the retail investors, have really shown resilience and poured money to the market. So overall, very positive on the market, but it may be a little bit volatile, but nothing to worry.
Certainly. And to your point of retail investors pumping money into the equity markets, you continue to see systematic investment flows of as much as 12,000 crore rupees every month. But David, I'm coming back to you on the other important parameter to track, which is the jobs scenario, right? And again, the resilience of the US equity, of the US market, of the US economy as a whole, the fears of recession, how bad that could be. In a blue sky scenario, of course, you could see that inflation might just taper off for the coming months and things will pick up once again. But is that blue sky scenario likely, or are we in for a bumpy road ahead?
The blue sky scenario is likely if you look at it through the lens of the latest unemployment numbers from the United States. The last week's non-farm payroll figures were very well received. They came in at 528,000, well above expectations. Economists were only predicting 250,000. It was a sizable increase on the previous month reading, It was the highest reading in 5 months. And on top of that, the unemployment rate ticked down to 3.5%. Its lowest reading in over 2 years. So the labour market is clearly quite strong in the United States. So in that regard, there is certainly room to be optimistic. That being said, if the Federal Reserve also view the very strong US labour market in the same vein as I do, they might use that as an excuse to carry out another 75 basis points hike in September. Today's PPI numbers have had a bit of information in there that was ever so slightly concerning. The core PPI reading today came in at 7.6%, ever so slightly below the 7.7% that economists were predicting. And it was a decent enough drop off from the 8.2% seen in the previous report. So the fact that it's dropped from 8.2 to 7.6 suggests to me that underlying demand is actually dwindling a small bit. So overall, I'll be optimistic with the economic indicators we've seen recently, but there certainly is elements for concern in there.
Certainly. Aditya, coming back to you, in a scenario, and I have asked David to paint a blue sky scenario, and he's commented on that, but in a scenario when things go the other way globally, where you have a slowdown in major economies, Europe, you have a slowdown in the US. In India, compared with what we've seen in major downturns in the past, you would agree that we're in a completely different scenario? Leverage levels have gone down significantly, and though we are at a higher interest rate regime than we have been in the recent past, as corporate India as a whole, we're more resilient now, and so we may not face that much of an impact. Is that fair?
Definitely. India is a very strong country this time around. Our forex reserves continue to be the highest that they've ever been for the country. The economy continues to do really well. We've seen 2018 to 2021 period where the economy was not doing really well. Now slowly and steadily the economy is starting to come back. Even if there is a global slowdown, the domestic consumption story, as Rhythm already said, India is a story of consumption as well as manufacturing now. So the consumption story continues to remain extremely strong. And I believe that over the period of next 2 to 3 years, the downtick in the economy that we had seen from 2018 to 2021 will start to recover, and we should start to move ahead on the economic growth numbers to about 6, 7, 8%, which is very good considering the fact that a lot of Europe and a lot of US could face potential slowdown. So in my view, there's no problem as such in the domestic economy. Global factors could lead to a slowdown. Let's say the prices of natural gas or prices of food, which could be really negative for India. But however, the domestic economy and consumption economy continues to remain extremely strong. And from that point of view, over the next 2 to 3 years, very bullish on the Indian economy.
Okay, so that's the message coming in. David, as well as Aditya, thank you so much for taking the time and pleasure speaking to both of you.